Smile, be, chat, join for networking.
Hello everyone, I'm John Edward, I'm from Best Mortgage for You. And what I'd like to do today is I'd like to give you an overview of the mortgage market in general and the things that you need to think about when you're actually choosing a mortgage product. Basically, a mortgage is really only a loan over a long period of time. So when we actually were youngsters and we actually took out a car loan over maybe 3 or 5 years, all a mortgage is we take that loan over maybe 25 years or 30 years or 35 years. And generally speaking, there's only two types of mortgage that you can actually take out. And the first type of mortgage is a repayment mortgage, and that mortgage is one where you pay back to the lender on a monthly basis capital and interest. And the second type of loan is an interest-only loan, and this type of loan is where you pay to the lender on a monthly basis just interest payments. That actually does leave you with the problem of how you're actually going to pay back the capital at the end of the day. And usually you might put into position some type of investment vehicle which is designed to build up sufficient money to pay off the mortgage at the end of the day. The thing you need to bear in mind is that investment vehicle is not guaranteed, so it won't necessarily pay off your mortgage. Typically nowadays, most people arrange repayment mortgages. So when you actually choose a mortgage, you have to actually decide what type of mortgage you want, whether you want a fixed rate mortgage or whether you want a variable rate mortgage. If you looked at both products side by side right now, a variable rate mortgage would be the lowest in cost. When you're selecting a mortgage product from a lender will actually require commitment from you to actually give you their best rates. So if you select a product which is their best variable rate, they'll expect you to stay with them for 2 years, 3 years or 5 years. So let's imagine that you go for the variable rate because that's the cheapest option. That's the option that keeps your costs down the lowest. But you're actually tied into that product for the next 3 years. What happens if UK interest rates start rising? If UK interest rates start rising, what then actually happens is you may think, I'd like to switch to a fixed rate product. And what actually then happens is you have to pay a penalty to get out of your variable rate mortgage product. So you've got to choose very carefully what type of mortgage you actually want and what's right for your situation and circumstances, because quite clearly it's very much dependent on what your own attitude towards risk is. If you don't want to take any risk at all with your mortgage payments, then what you should actually do is go for a fixed rate mortgage. When you select a mortgage product, you need to actually look at a variety of different things. And one of the things that you will be influenced by is what the actual fee is to access the particular mortgage product. Now, we may have mortgage products which have fees of £1,500 or £2,000, and you may actually say, I don't want one of those if I have to pay £1,500 or £2,000 to access it. The thing to do is to ignore the fee that you actually have to pay. And what you actually need to look at is you need to look at, if you're going for say a 5-year fixed deal, you need to look at what your monthly payments are going to be. And let's imagine it's 5 years and your monthly payments are £1,000 a month. That means you're paying 60 lots of £1,000, which means the cost of that product is £60,000. If the fee to gain access to that product is £1,000, that means that the cumulative cost of that particular mortgage product is £61,000. So you look at cumulative cost when determining which is going to be the best product in the marketplace for you. When you look at mortgage products and lenders actually charge fees to allow you access to their products, you have a choice. You can either pay that fee up front or you can have that fee added onto the mortgage. Now, conventional wisdom suggests that you should never add the fee onto your mortgage. And the reason for that is that if you add the fee onto your mortgage, you're going to be paying interest on that fee for the lifetime of the mortgage. However, I would ask you to bear in mind certain things. There's a lot of things that happen between time of application and time of completion. So let's imagine that you're buying a property from Fred Smith and you apply to the lender for a mortgage and you pay a fee of £1,000 up front, and then about 3-4 weeks into the transaction, Fred Smith says, I've decided not to sell my property. So you go back to the lender and you say, can I please have my £1,000 back? And the lender says, didn't you read the small print? It's not refundable. So always think very carefully about paying a fee up front, because you do risk losing that particular fee when you actually come to completion, if the guy decides that he doesn't actually want to go ahead. You need to think in terms, when you're buying properties, you need to think in terms of what type of survey you're actually going to have done on the property, because there are three main types of survey that you can actually have on a purchase. The first type of survey is a basic mortgage valuation. This is a survey which is used purely for the lender's benefit to determine whether or not they're actually going to lend on the property. You then have a home buyer's report, which is a slightly more detailed survey, and this particular survey gives you much more information on the condition of the property. And then you also have a final survey, which is a building survey. Now, a building survey is something which is much more detailed. Now, what you need to bear in mind is this is going to be the largest thing that you ever purchase when you actually are buying a house, and you need to make sure that you are aware of all the possible defects that are actually in that particular property. And what I would suggest is spend extra money having a more detailed survey done. And what you can actually do is, if you have a more detailed survey done and you find out that there are defects in that particular property, what you can actually do is renegotiate on the purchase price. And if you renegotiate on the purchase price, if you're contacting an estate agent and you're actually saying to an estate agent, I'd like a reduction on the price, the estate agent will say, on what basis do you feel you should have a reduction on the price? If you've got a surveyor's report which quite clearly demonstrates that there are problems with that property, and it quite clearly demonstrates how much costs there would be involved in remedying that particular situation, then you have a very strong position to negotiate a reduction in price. You've also got to remember that estate agents are not your friends. Estate agents are actually the friends of the person who's selling the property. And the more money that the estate agent can command on the sale of the property, the better the estate agent actually does. So just be very careful when you choose surveys, have a detailed survey done. As far as insurances which are concerned on mortgages, the only compulsory insurance which you actually have to take out is buildings insurance. There is no other insurance which is compulsory. Now, people aren't aware, but buildings insurance should be on risk from exchange of contracts, not from completion. The reasoning behind that is you might feel that the person who is actually selling the property has the property insured all the way up to completion. At the point that you elect that you're actually going to buy the property, and at the point that you exchange contracts, you're legally obliged to complete on the purchase of the property. If the person doesn't have buildings insurance between exchange and completion, and the property gets demolished because a plane crashes into it, what then actually effectively happens is you still have to complete on the purchase of that property. So it is sensible for you to actually have buildings insurance on risk from time of exchange, to make sure that should there be something that happens to that property between exchange of contracts and completion, then it's actually fully covered. So in terms of the mortgage market as a whole, that's an overview of the different things that you should consider. It's anyone's guess at this particular point in time as to what's actually going to happen with UK interest rates. And you need to decide when you're selecting a mortgage product how you actually choose that particular mortgage product in terms of whether you want fixed, whether you want variable. You also have to choose what term you want the mortgage to be over. Now, you could go into a building society or a bank, and that building society or bank could suggest to you, well, you're 40 years of age now, or you're 35 years of age, we can do a 25-year mortgage term for you. My recommendation to you is to go for the longest term that you can go for. So if you get offered 25 years, but 35 years is available, go for a 35-year term. And the reason for that is purely and simply, the longer the term, the lower your contractual monthly payments are. So if you go for a 25-year term, your monthly payments will be, say, £1,000 a month. If you go for a 35-year term, your monthly payments will be £800 a month. If you have contractual monthly payments of £800 a month, that gives you considerable flexibility, because you could start off with the £800 per month, and then what you could actually do is make manual overpayments of the £200 per month, and then you have a DIY mortgage term. So always choose the lowest monthly payment that you could go for based on the term. And any overpayments which you actually make on your mortgage, the overpayments that you actually make can't do anything other than reduce the term of your mortgage. Because once you've made your interest payments on the mortgage, then if you make additional overpayments, that's eating into capital. And my suggestion is, do structure your mortgage on the basis that you select a mortgage product that allows you to make overpayments, so that you are in a position that you can, when finances allow, you can reduce that debt accordingly. So ladies and gentlemen, that's an overview of the mortgage market, and that's really giving you an indication of the things that you need to consider when selecting a mortgage product. Thank you very much indeed.
Smile, be chat, join for networking.